Welcome back to the deep dive. We are jumping straight in today. There's a statement floating around from a major player that we just can't ignore.
Oh, yeah. Which one?
Tom Lee, chair of BitMine, big crypto strategist. He came out recently and basically said the bubble has burst.
Okay. Bold claim.
Yeah.
In what context? The whole market.
No, that's the key. Specifically in the digital asset treasury space. DTATs.
Oh, okay.
Yeah.
Deets. That is interesting.
Yeah, it's a huge statement, definitely grabs your attention, especially right now. So our mission today is pretty clear. We need to unpack what Tom Lee actually means by that. Why now? And crucially, what does this signal for you, whether you're investing or building in crypto?
Right.
We're really going to focus on the main metric everyone's talking about from the sources.
Yeah.
These DATs trading below their net asset value. NAV.
The core of it, yeah.
And just a quick aside before we really get into the weeds on valuation and all that. If you find these kinds of deep dives helpful, the ones that try to cut through the noise, liking, subscribing, maybe dropping a comment, it genuinely helps us out. It tells the algorithm people are watching and lets us keep making this kind of analysis for you. So, yeah, just wanted to mention that.
Absolutely. And it's important analysis to do. When someone like Tom Lee says bubble burst about a sector, they are just talking about like a 10% price dip.
Right, it's deeper.
Much deeper. They're signaling a fundamental breakdown in how things are valued. And in this case, yeah, the big red flag is exactly what you said. Companies whose market cap, their total stock value, is less than the digital assets they supposedly hold.
Less than the crypto on their books.
Exactly. And that gap, that should immediately make you stop and ask, wait, why?
Okay, let's definitely unpack that because it sounds wrong. If a company says, we have $100 million in Bitcoin, here's the proof. How can the market value the whole company at, say, $80 million?
It seems crazy, right?
Yeah. So before we get to the why, let's just nail down the definition. What exactly is net asset value when we're talking about these DATs?
Okay, NAV, net asset value. It's fundamental. For a D8, it's calculated pretty simply. You take the total verifiable value of all their crypto holdings, Bitcoins, stablecoins, whatever tokens, and you subtract their liabilities like debts and their ongoing operating costs. What's left is the NAV. It's basically what those assets should be worth if they were liquidated right now.
Okay, makes sense. So trading below 1x MNAV, market cap less than net asset value, that's the market basically screaming distrust, right? It's saying the corporate wrapper itself is somehow destroying value.
Precisely. The market's saying, we think you're going to burn through that $20 million difference before we, the shareholders, ever see it.
Wow.
It's a projection of serious investor fear onto that stock. And that discount, it's not random. It's the price the market puts on risk. You're essentially buying the crypto assets at a discount, yes. But the reason for the discount is the critical insight. It signals a potential failure in governance, transparency, or just basic competence.
But what are the specific fears driving that discount? If it's mostly Bitcoin, the most liquid asset on the planet, why such a gap? What risks are they pricing in beyond just, like, bad management?
It really boils down to realization and credibility. Can investors actually get that value? They're pricing in a few things, often together.
Okay.
There's execution risk.
Yeah.
Can management actually do anything smart with this capital, or are they just sitting on it inefficiently, burning cash?
Right. Operational costs chewing away at the assets.
Exactly.
Yeah.
Then there's dilution risk. Will they just keep issuing more stock to raise money, making your slice of the pie smaller and smaller? But the big one, often underpinning it all, is questioning the accessibility and security of those holdings. Is the auditing clear? Is the governance structure sound? Can we be sure those assets are safe and properly managed? If there's doubt, investors slap a heavy discount on it as a hedge.
A hedge against screw-ups, basically.
You got it. And you have to contrast this with the opposite, which we saw plenty of maybe a year or so ago. Companies trading at a huge premium to NAV.
Right, where the market cap was way higher than the assets.
Exactly. That meant investors were optimistic. They believed the company's strategy, maybe mining, maybe yield generation, maybe some software play, would create future value far beyond just holding the crypto.
So the current trend is the market swinging the other way. Hard. Correcting that optimism.
Aggressively correcting it, yeah.
Okay, let's get into the numbers then, because this isn't just theory. It's hitting investors now. How bad is this valuation crunch in the DAT space right now?
The figures are pretty stark. Forbes and some other industry trackers are saying roughly 15%, maybe 15% of all DATs are currently trading below that 1x MNAV line.
15%. Okay.
And if you zoom in just on the public firms whose main treasury asset is Bitcoin, K33 Research reported that about 25%, a full quarter of them now, have market caps worth less than the actual Bitcoin they hold.
A quarter of the public Bitcoin treasuries. Wow. So the market thinks a quarter of them are worth less than their primary asset.
That's what the pricing implies, yes. And we're seeing specific examples hit the headlines too, which really drives the point home.
Like who?
Well, a metaplanet is often mentioned as a clear example, trading significantly below 1x MNAV. Their whole enterprise value is lower than the crypto they list on their balance sheet.
Okay.
Another one often cited is Kindly MD, the ticker is NAKA, also facing this deep, sustained discount. And you have to remember the background here.
Right, the boom.
Yeah, the sources mention this huge rush, something like 30 or more new DATs popping up, many just in 2025. That kind of rapid saturation often means, well, a lot of them were built on pretty shaky foundations to begin with.
Just trying to ride the wave, maybe?
Probably. And the risk isn't just that the stock performs poorly. For the weakest ones, it could be existential. Some reports, NYDDG did some analysis on this, suggests some could be heading towards actual collapse if these discounts stick around or get worse.
Yeah, I saw that NYDD piece, How Dats Die. Pretty grim title, but it laid out the potential mechanism, didn't it? This forced selling idea.
It did. And that takes us straight into the implications for the wider crypto market. First off, this trend is like a flashing sign warning about, well, overexuberance and saturation. The market got flooded with these DATs. It suggests the barrier to entry, basically just setting up a company to buy Bitcoin, was maybe too low to deserve a lasting premium valuation.
The market's saying just holding isn't enough.
Pretty much. But the biggest risk for the whole crypto ecosystem, that's the potential downward pressure on Bitcoin, Ethereum, whatever assets these DATs hold.
Ah, the forced selling death spiral.
Exactly. If these companies' share prices stay in the basement or the discount gets really bad, management gets pressured. They might feel they have to sell their crypto.
Why? To prop up the stock price.
Maybe to buy back their own deeply discounted shares, trying to stabilize things. Or worst case, just to cover their operating costs and debts because they aren't generating other revenue.
Selling their crown jewels just to stay afloat.
And that's the death spiral scenario from the NYDIG report. If even one or two major treasuries are forced into big, unplanned crypto sales because of their own stock problems.
That could definitely push crypto prices down significantly.
Absolutely. It creates sell pressure that has nothing to do with Bitcoin's fundamentals. And this whole situation, it's driving natural selection, really. Survival of the fittest.
Consolidation.
Yeah, the weak DATs, the ones just passively holding, they'll likely fold or get bought up cheap by stronger companies with actual operations. We're seeing the early, kind of painful stages of that shakeout now.
And what about trust? Does this damage the whole idea of corporations holding crypto?
It definitely could chip away at sentiment. If the market keeps punishing the simple buy and hoard crypto strategy, it makes investors question that whole model. That negativity could easily spill over and affect perception across the wider crypto space, even for solid projects.
Okay, so it sounds pretty bad, but are there any counter-arguments? Is it all doom and gloom?
No, we definitely need nuance here. It's not like every DAT trading at a discount is about to explode.
Right.
Sometimes that discount might reflect more technical stuff, like maybe they hold some less liquid tokens or there's a big block of shares about to hit the market and overhang. It's not always a sign the core business is failing.
So context matters.
Hugely. And, for a very savvy, risk-tolerant investor, some of these discounted DATs might actually be deep value plays.
Buying the assets cheap through the discounted stock.
Potentially. If you believe the management is actually competent, the assets are genuinely there and safe, and they can ride out this storm. The big if. But you could theoretically get exposure to Bitcoin or other assets at less than their market price. High risk, though.
And the sources mentioned another key factor separating winners from losers: diversification.
Yes, absolutely critical. The DATs that seem to be holding up better are the ones with real operations, hybrid models.
Right.
Like they're staking their crypto holdings to earn yield, or they're running mining operations alongside the Treasury or providing other services. They have other revenue streams. They aren't just relying on the crypto price going up.
Oh, so they have a buffer.
Exactly. They're less vulnerable to this specific pressure. And, maybe this whole thing isn't a burst bubble so much as a healthy market reset.
Clearing out the weaker players.
Yeah, after a period of, let's be honest, pretty wild speculation.
Yeah.
These cycles often need these kinds of resets to prune the companies that don't have sustainable models, making room for the ones that do.
Okay, so given all that, What are the actionable takeaways for us, for the listeners, the investors trying to navigate this? What should we be looking out for?
Right. Practical advice.
First, based on the sources, you've got to be super cautious with DATs that have murky accounting or auditing. If you can't clearly see the assets and liabilities, that's a red flag. Same for companies with really thin operating margins or a history of constantly issuing new stock high dilution risk.
Hmm. Those factors just amplify the risk of that forced selling scenario we talked about.
Second, that NAV premium or discount. You absolutely have to monitor that trend. It needs to be a key risk indicator. If you see that discount widening sharply, that's when the alarm bell should really go off.
Totally agree. And critically, you should probably favor companies that actually do something. Look for those hybrid models we mentioned, ones generating real operating revenue from staking, yield, services, mining, whatever.
Utility matters now.
The market is clearly rewarding utility and operational strength, not just sitting on assets anymore.
Okay. And finally,
Keep an eye out for the restructuring. Watch for mergers, companies exiting the space, or forced reorganizations. These events can signal the broader shakeout is happening. And sometimes, maybe, they could offer smart entry points if a solid company picks up quality assets from a failing one at a deep discount. But again, requires careful analysis.
got it. This whole saga, this bursting bubble in the DAT space, it really connects back to that bigger theme in the source material, doesn't it? About what makes assets durable in the long run, especially thinking about AI in the future.
It really does.
This whole story is like a case study warning that just holding crypto isn't enough to guarantee resilience or long-term value. You need more.
Absolutely. It's a warning against complacency. Just because you put Bitcoin on the balance sheet doesn't mean you've built a durable business for the next, 50 years. The survivors, the ones who thrive long-term, they'll likely be the ones who effectively combine holding assets with real infrastructure, real utility, maybe integrating AI or compute, plus having rock-solid transparency and governance.
So it's not enough to be a passive hoarder.
The market's demanding you be an active integrator of digital assets now. That seems to be the message.
That really feels like the core lesson here from the sources. Value creation in crypto needs that operational strength, that strategic adaptation. Passive accumulation alone. The market's saying not good enough right now.
Well said. Which brings us to a final thought, something for you, the listener, to maybe chew on.
Okay.
If so many of these DATs are collapsing, or at least being valued at less than their core assets, what lessons should we take away from that when we evaluate other ways people try to get crypto exposure? Like, the endless this stock versus Bitcoin debate. Is the market always rational when it applies these deep discounts in the short term? Or does this kind of turmoil actually create genuine, albeit risky, opportunities for people willing to look past the corporate structure to the underlying assets? That's the question to ponder.